Welcome to this explainer. Today, we're diving into a massive shift in the fixed income world. We're talking about a structured product that, until recently, required a massive institutional balance sheet to even touch, AAA CLOs. And now, you can grab them in a standard brokerage account using ETFs. The global collateralized loan obligation market, or CLO market, has quietly exploded to over $1.3 trillion. That is a huge pool of capital. But why are everyday investors suddenly pouring money into it? Well, it really comes down to a historically unique blend of high yield and incredible safety. Here's our roadmap for today. We'll start by demystifying the CLO market, then look at the AAA waterfall advantage. After that, we'll cover the power of ETFs, weigh the yields against the risks, and finally, look at why not all of these funds are created equal. Let's get right into it. Section 1. Demystifying the CLO market. So what exactly is a CLO? Stripping away all the heavy financial jargon, a CLO, or collateralized loan obligation, is really just a giant securitized pool of syndicated business loans. These are often leveraged loans made for corporate acquisitions or buyouts, which get bundled together and then sliced up into different risk tranches. The absolute genius of this whole structure is how it brings totally different types of capital to the table. By spreading out the risk, it actually lowers borrowing costs for businesses, all while giving investors a highly specific menu of risk options. Whether you're looking for ironclad safety or you want high-octane yield, there is literally a specific slice tailored just for you. Moving on to Section 2, the AA waterfall advantage and structural protection. I love this analogy. Think of the cash flow from those underlying business loans like water pouring down from the very top of a structure. That AAA tranche sits right at the top, catching the very first drops of water. Because they're first in line, they hold the absolute safest position. And naturally, the risk increases as you move further down the waterfall into the mezzanine and equity tiers at the bottom. In practice, this creates a massive structural shield for that AAA tier. If the underlying loans start to default and cash flows dry up, the bottom layers, those equity and junior tranches, are forced to absorb the hits first. In severe stress scenarios, cash is even automatically redirected away from the bottom just to protect those senior notes up top. Because of that huge structural cushion, AAA and AA CLO tranches have historically experienced a 0% default rate over the last 30 years. Just let that sink in for a second. Through the dot-com bust, the 2008 financial crisis, the 2020 pandemic, not a single material principal impairment. Honestly, it's an incredible track record. Section 3, the power of ETFs and how this asset class got democratized. Historically, this incredible track record was totally walled off from regular investors. You needed $1 million minimum, tight institutional relationships, and you were locked into a highly illiquid, over-the-counter market. But the ETF wrapper, that changed the game completely. Now, for around $50 a share, you get daily liquidity on major exchanges, plus fully transparent daily pricing. It completely democratized access to this yield. Now, a quick but absolutely crucial word of warning. Please do not confuse CLO ETFs with regular leveraged loan ETFs. They are very different beasts. Leveraged loan ETFs buy the raw, unprotected BB or B-rated loans directly, which means they carry moderate default risk. AAA CLO ETFs, on the other hand, own these securitized tranches. That means they actually benefit from that highly protective waterfall structure we just looked at. All right, Section 4. Weighing yields against risks and evaluating the returns. So, we know they're accessible and structurally robust, but let's talk numbers. Historically, AAA CLOs pay a higher credit spread, often 40 to 100 basis points above similar corporate bonds or aggregate indices. Even better, they have a floating rate feature tied to short-term rates like SOFR, so their coupons reset regularly, giving you a natural hedge against rate volatility. You're essentially getting paid more without taking on standard duration risk. But, and this is important, safe from default does not mean free from volatility. During market panics, ETF prices can swing wildly away from their actual net asset value. For example, in March 2020, secondary market prices of AAA tranches dropped 8 to 12%, even though literally zero payments were missed. So while price drops don't equal credit impairment, the mark-to-market volatility is very real. You also have to factor in liquidity risks during extreme stress, and keep in mind that these distributions are taxed as ordinary income. Section 5. Why not all CLO ETFs are created equal, and the risks of active management. This quote from PGIM really hits the nail on the head.
Unlike passive index funds, every single CLO ETF out there is actively managed. The managers have immense discretion. Reaching for yield can dramatically change the internal risk of the fund, meaning just because it has AAA slapped on the label doesn't guarantee the portfolio under the hood is identical to its peers. To put that into perspective, take a fund like Columbia's newly launched AAAC. It sticks to a highly targeted mix, heavily concentrated in top-tier asset-backed securities. But other managers, well, they might quietly dip into junior AAA or even AA-rated tranches just to juice their payouts. And those second-paid junior tranches can act a lot more like AA debt, meaning they suffer much higher price volatility when the market inevitably hits a rough patch. As you look across the landscape, from massive established funds like Janus Henderson's JAAA to highly efficient players like PGIM and iShares to targeted new entries like Columbia's AAC, you absolutely have to look under the hood. You need to verify if a manager's specific active style actually aligns with your capital preservation goals, because sometimes a slightly higher yield just means they're taking on hidden risk. Which leaves us with a crucial question. In a fluctuating rate environment, are you capturing true institutional yield? Or are you blindly exposing yourself to unexamined active management risk? The yield in the AA CLO space is historically incredibly secure, for sure, but picking the right ETF wrapper for your portfolio, well, that is entirely up to you. Thanks for joining me for this explainer, and keep asking those hard questions about your investments.